Hey, welcome to the closing beat, everybody. Happy Wednesday. How you doing out there? Good, good. Glad to hear it. Is that silly? I watch a YouTuber guy that does that. The guy flies the planes. Steve-O One Knievo. He'll be in the plane and he'll be like, "How's everybody doing today?" Good, good. Got your seatbelts on? It's like really corny, but I don't know. It's a nice way to put it in there. Anyways, we're financial advisors here at Jazz Wealth. A little bit kooky, as you can tell. I hope you'll check us out at jazzwealth.com. We're going to talk about the stock markets here today. I got a lot of data to share with you, so we're not going to waste a lot of time. However, if you want to play Guess the Dow, jazzwealth.com/guess the Dow. Give me your best guess. There's some wild guesses out there, but you tell me where you think the Dow is going to close. Closest without going over, we'll send you a $100 gift card or credit your account if you're a client here at Jazz. And if you're not a client here at Jazz, shame on you. Anyways, let's take a look at the stock market here today. The S&P, so it comes in really second place, kind of a tie for first place there, down just a fraction of a percent. Not a big deal, and overbought in the short term. Totally normal to see this pull back. And we also have a known resistance area. That's the fancy way that the technical traders will call it. In other words, a place where the market sold off before. Well, why wouldn't it sell off there again? So that's what people are looking at here in the short term. Any catalyst, excitement, positive news. We didn't get that today, but anything that is positive going forward likely give you a reason to break out and above that. And so we'll see how things go from here. Thankfully, there's still plenty of days left in the week. If you look at the NASDAQ comes in last place today, losing 1%. It was just one of those days where, like, kind of like yesterday, the really large cap, like, tech stocks that have led the way and really helped support the market, they're just not participating. Apple down 1%, Microsoft down 1%, Meta down 1%, Amazon almost 3%, Tesla down almost 4%. And so when you look at the NASDAQ, there's not a really good reason for it to move higher. In fact, if I go back to the S&P here real quick, did a little quick study for you. Oftentimes what we'll do is we'll take a look at the market and we'll say, how much of a particular sector is causing the market to go higher? In other words, if you look at the entire stock market and say it's up about 7% for the year, roughly, is it all because of one sector? Is it because the tech sector did the heavy lift? How's this happening? Is it everything together? Well, in fact, that is not technically true. So let's take a look over here and see what we can find out. We've got the sector contribution gains for the S&P for the year. Down here, as of yesterday, the S&P up 7%, 750 basis points, if you want to look at it that way. 7%. Basis points, in other words, the percentage of each sector that is contributing to the gains. Well, we got tech. It's up 22%, and it owns 26% of the market. So it's 1/4 of the entire market. If it has a big gain, like it has for the year, then that is your recipe for why the markets moved higher. So example for today, the markets moved lower. Why was it? Well, tech didn't participate. 1/4 of the entire stock market wanted nothing to do with today's market and wanted to sell off. That holds the stock market back. So rather interesting to take a look at that. But if you look down the list, actually, what do we have? This is the weighting makeup of the market. So 26% is tech, 10% is consumer discretionary, and then you got industrials at 9, financials at 12, and healthcare at 16. So you can very quickly look at this and go, well, if tech goes lower on the day, but healthcare goes higher, we still could have a negative day. It'd be kind of a tug of war, you know, an even battle there almost, but we could have a negative day. Well, let's just see what happened here real quick. I'm just going to go over to tech, right? Don't make this too complicated on yourself. You know, we overanalyze this market a lot. Oftentimes we don't have to. Here's the tech sector. Obviously, I had a weak day. I just mentioned all the stocks that have not wanted to participate today. But if I go over and look at healthcare, whoa, that's a great day, 1.73%. Okay, let's go back to tech here real quick, 1.14%. But tech was down less than healthcare, so why didn't we have healthcare make us go positive for the day? That's because tech has 26% of the weighting in the stock market, whereas healthcare only has 16, right? So it would have needed to have almost a 1% greater gain on the day in order to nudge the stock market just positive. If you look inside of all of the healthcare sector, we're going to do that in a second for you, we can actually see where the excitement is coming from as well. So we start our day usually by looking at the index, the broad index. How did it do? It didn't do so well. It's kind of a quiet day. Why was that? And then we go down to the individual sectors and we go, well, year to date, tech is leading the way. Oh my gosh, 26% there, and healthcare is only 16. Now we know. The good news is tech really isn't pulling back that much, and it was overbought to begin with. So a healthy profit-taking pullback is more than fair. I have no issues with that. If healthcare was the lagger or the biggest drag on the market for the year, meaning it took away 68 basis points or just over 0.5%, well, that's great that now we have healthcare actually starting to rally. Well, hey, I like that, right? That's a good sign. But the problem is now this is getting extended, right? So it's a sloshing around going on in the markets right now. And that's the reason why we say, can you really put a whole lot of money into the broad market right now? Is that the best time? Right? Should we maybe consider this a little bit before we get too aggressive here? Yeah, probably should. Nonetheless, the majority of the gains by far this year have come from the tech sector. If that changes, the market's attitude will change in a heartbeat there. Okay? So first little nugget of the day. I got the goods for you here today. Let's dig a little bit deeper into the markets. Of course, the Dow. There you go. The Dow up ever so slightly today. For what the S&P lost, the Dow gained today. That's basically all it was. Healthcare was the reason that it helped that out. Bonds. We'll talk about this in a second, but bonds breaking above a little bit of a, oh, you can't see. Bonds breaking above a little bit of a congestion area there, ever so slightly, but breaking above is important. Remember, the higher the price of a bond, the lower the yield. And those of you that are buying houses and whatever else you're buying, of course, you want to see that, so that's a good sign there. If we go back to the S&P here for a second, I'm bouncing around just a little bit. Let's take a look at the, I don't know how well this is going to come up, but let's take a look here. There you go. All right, here are your top, not performers, your top contributors and your bottom draggers on the market for the year so far. We put 25 on a list. So Apple has about a 6% weight in the S&P there. It's up 27% year to date. Therefore, of the market's gains for the year, Apple has contributed the most to the gains. They get to celebrate that they've contributed the most. Microsoft and NVIDIA come in second place, each of them giving just over 1% total gains to the markets this year. In other words, if those three stocks were plucked out of the S&P, we'd only be up 4%. For the year. That's how important those three stocks really are. Combined totals, we've got 6, 11, 12, almost 13% made up of the S&P of just those three stocks. So that's why every day when I point those out, that's such a big deal there. On the downside here, not a whole lot of weakness. Initial weakness year to date came from healthcare, but now that's turning around. Right? So we look at that this week and go, healthcare's on fire, man. Healthcare's taking off. It's looking pretty good here. Heck of a play today in healthcare, second place today, but in second to last place year to date. We can now see why that is. So a lot of the healthcare stocks and of course banking stocks starting to wake up. Throw in energy, which has been up until this point kind of weak, and you can very easily put together a list of 25 stocks there. Right, so really kind of cool. Moving on from here, if we made a list of the top 100 largest stocks, meaning company by market cap, right? Apple would be, ranked number 1, and Amazon, and so on and so on. But if we made a list of the top 100 largest stocks in the S&P, but then sorted that list by which stocks have the highest growth expectations, come up with some interesting things, right? Remember, if the economy gets stronger, we want growth stocks. If the economy gets weaker, we want growth stocks and high margin stocks. Either way, there's a common denominator there, right? It's the numerator in this case, the way I said it. And so if we did that, we'd find out that T-Mobile ranks as the highest expected growth stock out of the S&P. Well, by sorting by the top 100 largest, right? So we drop the rest of them there. Progressive comes in second there. Growth expectations of 57% this year, 24% next year. Wells Fargo, you may not like them, but they're I don't like them either, but they're doing what they got to do over there. And so we have some growth expectations. even though the Fed's holding one of their arms behind their back at the moment. So we've got Target, 41%, 26%. Remember, Target is now a consumer staple stock. That, as of last Friday, it's a different category now. Salesforce, you probably could have guessed that. Salesforce is making incredible investments in AI, and it's probably smart because their platform is pretty complicated to use, so AI is going to help them out there. NVIDIA, Booking, Walt Disney, ServiceNow, and Starbucks. These are your top 10 highest growth stocks, at least going forward for the year. And then I put the projections in there for next year as well. You with me so far? Tell you what, man, you give me nothing to do, I'll take care of it. Utilities, that's going to be your best performer here today. Why is that? Well, that's bonds. Bonds breaking out of a range. These two are correlated. The higher price, the higher price of a bond, the higher price of the healthcare, the utility sector, because it means lower yields. And those guys, they need to borrow as cheap as humanly possible there. Now, the assumption is we have a Fed rate hike pause coming up here soon, and that would be a really, really good thing, right? Would it be? Yeah, let's take a look. If we go over here, just shared this with you yesterday. Which sector has the best median returns when the Fed stops hiking rates? I'll give you a hint, starts with a U. Utilities, 5% median gains there. We covered this yesterday if you want to know the details. So what does that tell you? Utilities are not very exciting, but it tells you that those people believe that rates will continue to move lower, prices move higher, and the Fed's about to stop hiking rates. Maybe not this next May meeting, but at some point soon, they're going to do it. They've reached sort of the plateau. And so that's why you have money going into utilities. Really, really cool there. You got to be a part of that one, as boring as it can be. Talked about healthcare there. It is second place today, second to last place year to date. However, it's the fastest moving sector over the last 5 days there. So I thought we'd dive just a little bit into it. Remember, index, sector, and then inside the sector, what's driving that? Is there one stock? Is it a grouping of stocks? How do we break it down? Well, if we take a look over here, this is a little bit different than what we normally do. Here is the most beautiful chart that I could make of the healthcare sector broken down by industry. So healthcare encompasses a lot of things. There's pills, there's healthcare service centers, there's hospitals, there's medical devices, right? There's software, there's AI now. So it breaks down into all this. Research is one of them. So pharmaceuticals make up 29%, healthcare equipment 19%, biotech 16%, managed care 14%. We don't have to go through the rest. Healthcare supplies 1%. All right, that's pretty small amount there. Let's compare the industries year to date. I'll be darned. That 1% of the sector is basically where all the gains are at. 33% gains there. The S&P up 7.5% as of last night when I made this. And as you look through, is it healthcare services? Do I want to participate in that? Do I want to participate in managed care? Not unless you like a pullback. You know, you like a good discount. If you like momentum, you like the facilities, you like equipment, you like supplies, things like that. Those are more non-cyclical. We're going to get sick. We're going to need to buy the stuff. You know how that goes. So rather interesting of that one there. Now, that's the performance of each individual industry. From there, what can we do? Now you know. We just did it, right? We can scan for the highest growth prospects, and we can use any metric that we want, but let's take a look and see what we can do. Because I can't tell you what stocks to buy, but I can point you in the direction of what Wall Street thinks, and you can make your decisions from there. Here's the top 10 list, and we did it in a couple different ways. I wanted to include 2023 and 2024 because those projections are in, and that's all expected there. I also wanted to include changes in earnings estimates because we got earnings season coming up. We want that in there as well. And then these are your best performers. Oftentimes, the novice investor will go look for the best performer and find an opportunity to participate in that. However, if the best performer is already pricing in all of their growth, you missed it. So we want to kind of use other metrics to look around there. For example, as far as earnings growth here in 2023, Insulet ranks as number one. PODD is a ticker symbol. If you have diabetes, they make the Omnipod. It goes on your I'm assuming most of the time it goes there. That's where I see people wearing them. But they make the Omnipod there. And, you know, spotty on profits, but the growth is incredible there. And of course, they're predicting that there'll be a lot more growth. So they rank as number one. Where do they rank for next year's growth? Still solid. So here's a company that maybe you don't know a lot about, but it may be worth doing some research because their growth rates far exceed everything, almost everything else in the sector. Interesting, huh? It's a medical device. Not a supply, it's a device. So rather cool to look at that one there. Dexcom is similar. You've probably more heard of Dexcom if you know anybody with diabetes or that needs insulin or needs to track that. A little bit more technologically advanced company, but same thing. This is a company that has better margins. So see what I'm saying? I went from the index to the sector and said, something's odd here. What about that sector? Let's look at the industry. Oh, wow, look at all the excitement over here. Is there any particular stock that's going to continue to play along with that? Oh, look at these stocks. Here, they have this growth. So very quickly, well, at least I'm making it look that way, you can maneuver your way around healthcare, and you're welcome to do screenshots or whatever you got to do there. So like I said, I got a lot of stuff here. Got a lot of stuff here for you. Financials. No. Ta-da. Financials. So financials are, you know, they've had a rough couple weeks. But financials are the second cheapest sector out of the S&P. Looking forward, right? So we're saying over the next 12 months, what is their projected valuation versus where it's at? Well, they're the second cheapest in comparing it to the other sectors. However, they have the highest growth rate expected for 2023. So you're getting something that is cheap and expected to appreciate. That would be like this. I don't know, let's use a house. So that would be like saying, I look at all the property in the neighborhood, and this one is cheap, probably for good reason. It's been beaten up, right? Just like financials, been beaten up a little bit, but its projected growth rate, even if it's not even quite perfect and everybody's wrong, this is something that should appreciate. A little love, a little patience, and maybe we can get something that appreciates. So if you take a look, financials are the second cheapest, but they're expected to grow the most. So here we have their price relative to earnings. They call it forward earnings. So you look at that. All the way down here at the bottom almost, you've got financials. 12, let's call it 13 times earnings. We could probably still say 12.5 times earnings because it didn't do much today. Earnings growth for 2023, 20.3%. Utilities the same. A lot of those people believing that rates will find their way lower. So a little bit of a second thing there. But what happens if this projection is a little bit off, but also the Fed stops raising rates? Well, let me just refer back to our previous chart here. So if the Fed stops raising rates and the estimates are off by 50%, 70%, 80%, we still have a high probability of a strong sector that can gain, and historically does gain, after the Fed stops raising rates. So now we just did all this analysis, and some of you, your eyes are glossing over. Okay, but that's different. I don't hear you do this often. But all I'm trying to do is show you a step by step, how you can look at it. Then put the pieces together and go, well, that's the data, but we just heard about some other data that was good. When the Fed stops raising rates, financials do well, utilities do well. Well, that's kind of interesting. Now we put those pieces together and you say, I've got some homework to do, right? I'm not saying you buy a particular stock. I'm just saying, brother's got some homework to do. So I hope you learned something for that. I think you will find, are a little bit different in our approach to how we handle things. Financial advisors, in my opinion, should not just be, tapping you on the back and saying, you got to ride the markets, man, up and down. Okay, there's some truth to that, but let's do more. We're here. Let's do some work. ConAgra. I told you yesterday, this one, it doesn't tend to move a whole lot, right? The odds say it's not going to move a whole lot. It didn't move a whole lot, but I would say that's above average there. Better than expected earnings for ConAgra. Raised their guidance going forward. They said there wasn't as much sales elasticity in their earnings report. That was an actual quote from the CEO when they gave their conference. That means that they were still able to sell stuff at reasonable margins, and margins did not go down. In fact, they went up. That's elasticity. You're willing to continue to spend a little bit more on a product, and therefore that allows them to enjoy a slightly higher margin. FedEx in the news here today. They're trying to save about $4 billion. And don't worry, they're going to do that, but they're going to raise the dividend as well. So the shareholder does not have to worry that somehow they will not enjoy the appreciation that they have. UBS in the news, they said Credit Suisse is going to take about 4 years to get this fully integrated. I believe that. That is no easy undertaking, considering they had no plans to do that until the opportunity presented itself. So, yeah, I'm going to say that that's probably a fair assumption, if not longer. ExxonMobil, because of the backwardation in the energy markets, they say, you know what's going to happen? It's going to hit our earnings because we don't operate like traders. We operate like investors. It's going to cost them about $2 billion. And feels like it was about a month ago when we were talking about the differences between contango and backwardation in the futures market, if you want to learn about that. And then Constellation Brands, they'll have earnings out tomorrow. Think the alcoholic stuff that makes you feel good. That's really the only people reporting earnings tomorrow that will get any attention. So I'll let you focus on that one there. Jazz After Dark, we've had some good ones here lately. We talked about when to buy gold in your retirement accounts. It showed some of that performance and returns there. We've looked at recession odds based on inversions in the yield curve. So all of this sounds complicated, but really simplified and sort of visual ways of sharing things, which I like to do. And so I hope you'll check that out. I will now attempt to do this guy here, stretch out this, and hopefully answer some questions. Move this guy back here. Yeah, what do we got? DIYer girl likes the stuff. Okay. Good. That makes it all worth it. Oh, man. Thank you for doing. Yeah, you're welcome. Happy to do it there. I keep saying that you will not add a big amount of money on the current market. What should happen to change your opinion? A pullback. Just pullback. That's it. Broad market pullback. Now, you know that hasn't really happened this year, right? Pullbacks have been sector driven. Remember we talked about when we added to our financials positions, well, that was that sector. All right, temporary little emotion, excitement. Oh my God, the money's leaving the banks. We go, okay, let's take a look at this. Let's do a deep dive. And then let's say, we're not adding money to the broad fund or to the broad market, but we go, how can you not like the fact that financials are cheap on a valuation basis here and have that growth prospect? Sounds like something we want to take a look at. So the point of me saying that is, what happens if maybe it's healthcare that pulls back? That's overbought right now. Maybe that pulls back. And you can, as it's pulling back, you can go, okay, what makes sense? What do I want to do here? What stocks do I want to buy? How do I want to participate if you want to participate? So, well, we'll see. I'm not saying that that's going to happen. I just was using them as an example because, well, they're the most extended. That's the fastest moving sector right now. You go, well, that's not going to continue forever, right? Yeah. How big of a pullback? That's the tough part. So you never know how big a pullback's going to be. So that's the fun ones that I like to do with you guys. When the market's pulling back, you go, no, don't mess with it. Hang in there. That's a weird pullback, right? So I can't say ahead of time, like, if we fall 5%, I'm in. What happens if we fall 4.9%? And what happens if we fall 4.9% because everything, tech was the only thing that pulled back? Does that warrant buying into the market? Right. So that's why I don't have a good answer to say, here's a hard and fast number. Every pullback's different. And now you've kind of seen that this year. Yeah. Thanks for breaking it down on the data. There you go. Matt's, where's the damn Twinkies? Where are the Twinkies? Oh, they're up there. They're right there. You got it. All right. Well, I may have committed just a little bit more time to some of this info for the show today, so I do still have some work to get done here. I appreciate you guys hanging out with us. I'll be back tomorrow, of course. In the meantime, I appreciate you guys watching. We'll make sure you can see the Twinkies there to keep everybody happy, which reminds me, Cody, I got something for you too. But you guys enjoy the rest of your day or evening, and we'll see you tomorrow. Adios.